Hi everyone, Frank Fantozzi here, President and Founder of Return on Life Wealth Partners. Welcome back to Frank Wealth Insights. Today with me is my colleague, friend, and world traveler, wealth advisor Cynthia Yang. Before we jump in though, this podcast episode is intended solely for general information and educational purposes. It does not constitute financial, legal, or tax advice. Listeners should consult their own financial, legal, or tax professionals regarding any information before making any financial decisions. So today we're going to do more of a current event and talk about the economy, the markets, what's happened in the first half of 2025, and what might lie ahead and what that might mean for all of you. So Cynthia just got back from China and also a vacation in Japan. Yep. She was visiting family. So I was curious, considering we're in a world economy, what really stood out, being outside of the United States and hearing and seeing the information from another perspective in China and Japan that you saw relative to the markets and the economy and from a world position?
Well, it's really different when you're a traveler out there. You really enjoy the food, the scenes, and everything there. So it's a kind of a different perspective there. But from the economic standpoint, I've talked with a lot of friends, family about traveling there with other travelers. I've seen a couple of things really stood out in China. For the Chinese, it is kind of obvious that for those who have business overseas, they are very concerned about what really going on with the trade policy, with the tariff, and those business owners, they can't try to figure out where the road ahead for them.
Okay.
And the other thing is really the employment in China. There are, especially for the young graduate from college, there are concerns about where they could find well-paid and a really good job for at their landing career for the future. And a lot of those young college students after graduation are hard to find a really good job. There are some numbers there quoting about 15% unemployed right after college, or even up to 20%. So that's something really worth concerning there.
Okay. Well, we talked about, internally in our office, and, we talked to clients that, getting good information out of China is always a little bit challenging, but we understood that they've had their own version of a slowdown and a recession over the past few years. How is that impacting, their recovery? Because I know they're trying to recover in the midst of all the things that are happening, with the new administration, which we'll get to in a second.
Yeah, I would say that a couple of things. When you look back 4 or 5 years around COVID and after the reopening, pretty much the rest of the world reopened like 3-6 months into the pandemic. But China, it took them 3 years to really reopen. And the world were kind of expecting that we're going to have a reopening rally in China. That really never happened yet, or so far, we haven't really experienced it yet. So how to really reboot that momentum for the economy is still going to take some energy to really figure out what they need to do policy-wise to stimulate the consumer spendings, to stimulate. And one thing that I think is very interesting to see that right before COVID, you can see there are tons of tourists visiting China.
Right.
And because of the shutdown for almost 3 years, those tourists, they got to go somewhere else.
Right.
They pick a different tourist location. It's either European or Japan, which is one of top choice in a lot of tourist mind. And the international airport in China, there isn't much traveler out there.
Wow, okay.
So you can, from that standpoint, they're not attracting the tourists back to the country.
Okay.
So the spending are not really there.
All right, so the tourism industry really got hit.
Yeah.
Okay,
yeah.
Okay. So it's fair to say China is probably a little bit more behind the rest of the world just because they took a longer pause during COVID than every other country, every other nation. Okay.
Yeah.
All right, good. Well, thanks for sharing that.
Yep.
So a lot's been happening in the United States, and obviously with the United States being the financial influencer in the world, obviously India and China are big players as well, but everyone tends to look at, the United States as the leader, and then what happens based on the decisions that are being made. And we saw back in the election when at that then President Trump, when he won the election, there was what we called internally the Trump bump, which was all this anticipatory well-being got pushed into 2024. So everyone, from a financial standpoint, if they looked at their investment statements, saw a nice little kick. But unfortunately, that little brief honeymoon of a couple months was short-lived when, what's surprisingly, it was short-lived, but what was surprising is the actions that were being taken by the new administration were already telegraphed, we feel, by our research and publicly, were telegraphed at the election. But then when everything started getting implemented, I think the swiftness and the severity of, the cuts in the government, right? All the tariffs, all of a sudden, the whole economy really got shaken in the first quarter. And pretty much, from a mechanical standpoint, was a kind of a pseudo pullback in the market and, potentially a reset, or, are we heading into a recession? And then all of a sudden we had this sharp turnaround at the end of April, May, to taking us to where we're at. Now we're at an all-time high in the market. So the question is are we going to continue down this path of expansion and a bull market, or was this like a false positive? And, we're going to dive into that. But I think that the roller coaster from, President Trump being elected, the Trump bump, the 15 to 20% drop, depending on where you were looking at in the marketplace, and now being at an all-time high, has everyone kind of saying, okay, what should we expect? So what are your thoughts on the first 6 months, and what things have we gleaned, and what have you gleaned from that? And we can talk about maybe where that can trail out into the next 6 months going forward.
Well, I mean, it's like $1 million question that where the market is going to go next from what we have experienced. To just take a look back to what has happened in the last 6 months, when you look at the GDP, from the GDP standpoint, Q1, we had a little bit pullback with a negative GDP. Someone may take that as a surprise, which should not be when you look at all the discussions about the trade policy, the tariffs, that a lot of businesses are trying to be strategic about stocking up for what's going to happen in the future. So as you can see with the numbers that we both seen, is the imports in Q4 of last year, average monthly is about 270 billion a month. And that number jumps to 330 to 340 average monthly for the Q1.
They were stocking up.
Yeah, they were stocking up. And when you look at how the GDP, the gross domestic production are being calculated, import is a deduction to the GDP. When you have more imports, we are spending money. And that take down where the GDP are likely to be landed on. And by no surprise, we had a negative number for Q1. And then looking forward for Q2, we started to see a slowdown in terms of the imports. And with that, I don't think there will be a surprise that we have a positive GDP for Q2. And so don't take Q1 as an indicator that we are having a slowdown or a recession down the road. And I won't be very thrilled that we have a positive GDP for Q2 that as an indicator for a recovery. It is very well being short-lived. And the reason really behind it is all those massive shifting between the importing numbers.
Right. Yeah, and I've seen similar things when we talked about it internally at our office. The big issues are, tariffs, what's happening with fiscal policy, what's happening with labor. And I think what we're going to see in the next 6 months is the effect of tariffs. So let me jump back a second. I think I would call the first 6 months, and probably going forward, a lot of uncertainty. Yeah. President Trump has come in wielding a hammer, and he's been very inconsistent. Okay, he's coming in, and instead of being friendly out of the gate, he came in and started slapping down heavy tariffs and very large tariffs. And then he's retreated off of that. And you saw that happening in the market when he pulled back and kind of took a pause on the tariffs. The markets responded more favorably. To your point earlier, we haven't had a big spike in inflation yet, and I think a lot of that has to be because of the pre-ordering and stocking up. Those costs haven't been really passed on to the consumers yet. And companies, I think, have waited to see if President Trump and the administration are going to really follow through and increase and continue to increase tariffs, or are tariffs kind of set now? Because he's anticipating, and part of the tariff was to equalize the trade imbalances that were perceived between the various nations, and that historically our country was on an unfavorable landing page with other countries. I think the other issue is he's using tariffs. When we talk a little bit later, we'll talk about the tax bill. He's counting on tariffs to kind of subsidize the part of the deficit spending that he's causing. So there's a lot of moving parts, but I think the impact of the first 6 months we talked about is, I think the next 6 months we're going to start seeing more of the impact of tariffs. The labor market, when you look at labor statistics, there's been a little bit of slowdown in hiring. When they look at hours being worked, that's gone down. Overtime has gone down. And so the question will be happening in the next 6 months is, will we start seeing a reduction in the workforce depending on what happens with the tariffs? Are these costs going to be passed through, which might uptick inflation? And I'll have you talk about, if inflation kind of stays where it's at or upticks up, is that going to paralyze, the Fed from, the planned lowering of costs? So I think going back to the word uncertainty, I think that's what's created a lot of confusion in the marketplace. And even though we have this high point in the market, the question is, can it hold itself there given these undercurrents that might play out in the next 6 months?
Yeah, I would say that the impact of the trade policy and the tariff will slowly surface in the second half of the year, and more likely to 2026, to the point that because a lot of the business are stocking up, inflation may not pick up very quickly in the second half of the year because of those overstocking. It takes time for those to flow through the system. And then over time, if we do have a spike into the tariff and the new costs are being added to the new stocking, that's probably, we're not, as a consumer, we're probably not going to feel that in 2026. So inflation, I think it may take a little bit longer time for us to see if it's going to pick up in the future. I think more of a recent and immediate impact is really business that take a pause because they don't really know where to go because of the policy uncertainty. And because of that, all the energies and the resources should have been spent for renovations, for expansions, are taking a pause. So they're not hiring new positions. They're not really spending the energy. And because of the pause in the short term, it's going to have a more immediate impact to the labor market. It's going to have more immediate impact to the wage growth in the near future.
Yeah. Well, clearly you touched on a really important point. If they're not going to spend money because of uncertainty, and you can imagine, put yourself in the business owner's seat. I want to spend money. I want to expand. And if a lot of my costs are derived from taking imports into the country, how do I plan to build a plant? So think about it as a consumer. I want to build a house, right? And I plan on spending, $500,000 on the house. That's my budget. But in the process, all of a sudden, costs start being passed on, and my house goes to $600,000. Well, am I willing to take that kind of risk as a consumer? So I won't build a house. The same analogy applies to the business owner. If I'm going to build a plant to expand my product line, to produce more, which then, from an economic standpoint, is an economic engine, and then also hire people to fill that plant, I'm going to pause because I can't count on the material cost that I'm going to be used. So I think companies that are in the manufacturing industry are ones most susceptible to tariffs versus the service industry. So you think about banking and finance and things that are service related. the tariffs aren't really going to impact the, their services or the costs that they pass on because it's intellectual property, it's a service. But clearly the manufacturing industry is more at risk. So, from a standpoint of expanding and hiring and producing more, as you put it, they're going to pause, which then creates a lagging effect to the economy because eventually that will catch up. It's like throwing a rock in a lake. It creates a ripple, and that ripple eventually will get to the shore, and that's what's eventually going to happen, the second half and possibly the first half of 2026.
Yeah. On the labor market, what we already seen, and you point out that there are already a slowdown or softening in the labor market, and the hiring new positions are less than what we've seen during the peak time around 2021, 2022.
Yeah.
And that's not really hit us by a surprise given what is really going on in this economy and a lot of those political uncertainties out there. And what I think going to happen is some are concerning about, okay, so we are starting to see the slowdown in the job market. Now, on the positive note is the wage growth is a major component to the inflation.
Right.
When you see the slowdown in the job market, and that can ease a little bit of the concern about uptake inflation near the future because the job market are really softening. And that is a key component to the CPI. Yeah. And on the flip side, people are concerning about, okay, are we going to have a recession because there are going to be massive layoff and people losing their job, they're not going to afford to spend what they used to spend on.
Right.
And I think most of the business owners have been experienced the pain of not able to find the right talent during COVID time.
Right.
It was very challenging.
As we saw when we were trying to hire people, couldn't hire anyone.
Yeah, we have tons of openings out there, but less applicants are really filling those positions. So I think a lot of business owners, because it's so recent, are still feeling that pain.
Yeah.
So they probably going to be very reluctant of let the right talent go.
Right.
So that may help in the near term that, yes, we're not going to see a lot of new positions adding to the economy, but at the same time, we're probably not going to really experience a massive layoff for that reason.
Yeah. And I agree. I think part of it is to what extent, tariffs are going to come into play. And I think that's going back to the uncertainty. We really don't know in all these negotiations. I mean, we're not behind the scenes. We're not a fly on the wall, kind of listening, between all the negotiations. We really don't understand to what extent these tariffs will continue to impact. If they stay where they're at, I think there's going to be a lingering impact, but it's not going to be a major impact where the economy can't handle it. And the economy's shown that it's been very, very resilient. But eventually, costs are costs, right? And when you look at fundamentals, when you look at the value of a company and its stock price, it's always going to come down to earnings.
Yep.
So if top line gets affected and and costs get affected. So if costs go up and top line go down, profits get squeezed. If profits get squeezed, your earnings go down. And when you get your earnings report every quarter, the value of the company is going to change. Yep. And so I think that's a dynamic that people can't lose sight of. With all these moving parts, at the end of the day, it comes down to are companies continuing to be profitable during this stage? Does this have severe long-term implications? No, but people tend to be short-sighted when it comes to their portfolio and their money, and so all these hiccups that you see in the fluctuation in their portfolio, especially with the level of news and information that's kicked out there. People tend to absorb so much of it that they start to make decisions that usually aren't right long term. So the fear for us as advisors, and when people look at it from a pure investment standpoint, is are they going to continue to hold the line with their investment strategy, or are they going to raise the white flag if things get really lopsided and start to make changes which aren't in their best interest?
Yeah. Earnings is really something that we need to pay close attention to. And when you look at the valuation, the U.S. stock market, the valuation are already kind of stretched.
Yeah, like 22 right now?
Yeah, 22. there isn't much room in terms of just the price appreciation.
Right.
If there is any return in the near future, it has to be supported by solid growth in the earnings. And what we have seen so far is Q1 and Q2, the earnings are still remarkably strong.
Right.
And we have a 13% earning growth in Q1. And if you just look at the significant or magnificent 7,
yeah,
the earning growth are above 30%, which is quite a surprise for us. In a certain way that there's still a ton of cash on their balance sheets. They're still spending ton of investment back to the R&D.
Right.
So with a 30% growth, their stock valuation are expensive for a reason, because the earnings behind the scene. So down the road, if we expect to have continue rallying the stock market, there has to be the strong earning growth following and supporting it.
Correct. And I think also you have to kind of chop off because the Magnificent Seven occupies so much of the value of the S&P 500 that you have to be careful that, not everyone's investing everything in the Magnificent Seven. And, if we make a general assumption, if people are investing in mutual funds, they have some direct exposure to the Magnificent Seven, but the other part of the S&P 500 or the Russell 3000, those are other companies that also have to carry their weight. You can't be just the 7 companies that carry the stock market. So eventually, if these headwinds continue, we could see more valuation changes in the stock market and more volatility, which could create an opportunity to buy. If there's a pullback again, a 10 or 15%. There's an opportunity to put money into the market. But I think we could agree that by the end of the year, if we had to say, all right, are we going to be positive or negative in the stock market? I think we're going to be positive. I don't think it's going to be at the rate that we are at today. We feel that, given all this information, it still has to play out. And people need to realize that things that happen in the stock market or just in the economy in general, it's not like a light switch. It's not you turn it on and off and things happen instantaneously. Anytime there's an impact, whether it's tariffs and taxation, or we haven't even talked about geopolitical risk, all those things tend to take time to work its way through the economic machine before it actually ends up showing up in the economy.
Yeah. So really, you touched about the rich valuation in the technology stocks, and there are still so many other stocks out there. At the next 6 months to a year, really the same is to be selective.
Yes.
Selective to be really actively managing your investment portfolio and see what do you own in your portfolio. And risk management is also a key when there is expected volatility in the market.
All right. Okay. And we'll talk about, towards the end, we'll talk a little bit about stock market positioning and portfolio positioning and strategy, and maybe we'll touch on alternative investment assets. I want to bring up the, kind of the newer news, the big beautiful bill that's getting passed and seems like it's going to get approved and go into play. So, a couple things. It's really geared to, again, stimulate, the economy.
Yep.
Technically, the bill should be revenue neutral, but it is not. And I don't know how they're working around that part of it in Congress. So basically, I touched on earlier how the tariffs are really going to, they're expecting $2 to $3 trillion a year from tariffs to help offset, the deficit spending. Because right now, if you look at our economy, our interest payments alone are close to 20%. Probably within a few years, a quarter of our government's expenditures is just interest expense, which means it does nothing for the economy. And what happens for the government and for the economy as a whole and for U.S. citizens is that the government has less money to spend on other programs like Medicare, Medicaid, and things like that. So this interest rate burden is becoming a problem. And whether they keep kicking the can down the road and saying, well, future administrations will have to deal with it, it is a real problem, especially with our debt growing. And so this whole deficit spending is an issue that I think the current administration is glossing over a little bit, and they're really relying on these tariffs to help offset that. Because as the bill stands, we are giving more tax breaks in general. Okay, now we're not going to have time today to get into who's getting all the tax breaks, but the impact on the economy and the receipts coming to the government are not going to offset. So that's going to add to our national debt. Mm-hmm. However, the market perceives the big beautiful tax bill as a positive, as a stimulus to the economy. So I think that also, once that kind of passed the House and it'll get through the Senate and everything will be passed, it'll actually, the market's viewing that as a positive to the economy. So I think that's a counterweight to some of these headwinds.
Yeah, well, markets are always forward-looking. When there is a news, it can price that in already into the market. So down the road, I wouldn't expect too much of the market volatility caused by the big beautiful bill if it's passed and down the road, because market already expecting that to be happening. And as you said, anything in the market is going to take time for market to digest it, to flow into the system. So there's not going to be a light switch that, okay, the bill is passed today and the next day we all feel whether it's going to be a positive or a negative impact to the market. Yeah. And I heard one of the discussion they were talking about on the individual tax filers. The impact may not happen until after April 15th next year, because even though you can run your estimated tax return to see that, okay, with the new tax bill, it's going to save me X dollars, but it's not until that day you file your tax return, everything is finalized, and that's money saved in my pocket.
Right, totally, I totally agree. Switching gears, how do you feel for Fed Chairman Powell? I mean, he's got all this pressure. First of all, he's in the crosshairs. Him and Trump obviously don't get along, even though the Fed's supposed to be totally independent from any president, any government, the House and the Senate. But the whole plan was to start lowering interest rates this year again, and that hasn't happened. And there's these headwinds, with possible inflation. So they're being cautious that they don't want to take their foot off the pedal with lowering interest rates. So what do you think Fed Chairman Powell's thinking right now?
I think he is doing a great job trying to be as independent as possible, because there's so much pressure, not just from President Trump, from the market calling for rate cut. And Fed are trying to there are two mandates Fed are trying to do is one, price stability, and two is a full employment. Right. Now the market in the last 2 years, Fed were trying to do anything they could to bring the price stability, put inflation under control. So they were willing to sacrifice a little bit of the job market. Right. And luckily, we haven't seen too much impact to the job market. We are still statistically considered to be fully employment right now. And down the road, I think what they're going to continue to do is being data-driven and data-dependent to really see where the data are leading us. If, as you pointed out, we started to see that the job market are softening and weakening. If that continued down to that path until a point that Fed says, okay, full employment is more at risk than the inflation, and they're going to turn that switch on to cut the rate sooner than what they have indicated.
Yeah. So you're totally on point, totally agree with everything you're saying on how I would be feeling if I was Chairman Powell and the actions he's taken. I think being data-driven, it doesn't hurt to be a little more cautious, because from a business standpoint, the current interest rates, while I'm sure businesses would welcome a drop in interest rates because it's a cost, it really hasn't slowed them down. I think the noise that you hear is really in the housing market, but I think people forget the housing market's not just impacted by interest rate, it's impacted by housing supply, which is still really, really, really low. We just don't have the inventory. Yeah. And then the competition, back when housing markets were robust back before the Great Recession, we didn't have Airbnb and VRBO and all that stuff. And so now you have industries that are buying houses that can afford to pay a premium. When you look at buyers, most consumers are financial buyers.
Yep.
They're not premium buyers because they're not going to usually take a personal residence and figure out a way to flip it and their personal residence and make money on it. So I think the combination of the interest rates where they're at, the economy in general where you have supply issues and competition from a newer source, relatively newer, is really still contributing to housing prices. While they've inched down a little bit, they're still pretty high.
Yep.
And so especially when you look at the market, and I'm going to use the Cleveland market in general because obviously $500,000 in Cleveland is not the same as $500,000 in LA or in New Jersey. So when you get into the middle class marketplace and you're looking at houses from $100,000 to $500,000, that becomes a real challenge for people. So I think interest rates will help fuel some of that. And going back to some history, I think part of the reason why we didn't have some of the challenges in the housing market is people locked into such long-term loans before before the COVID. They didn't need to worry about the interest rate increases. They were just going to stay in their home. So you didn't have the inventory turnover.
Yeah.
So I think interest rates right now are going to still be in play. It's going to impact the bond market a little bit. Inflation's not usually friendly to bondholders. So I think there's a little bit of trepidation when we start talking later about investing and positions and all that. But I think right now that still has to play out, and we'll see what Fed Chairman Powell will do if he finally will cut rates in the fourth quarter or not. But right now I think it's still 50-50 because he and the board are going to wait and see. All right, in regards to the dual mandate, are we going to have full employment, and is inflation in a position where we feel comfortable lowering interest rates?
Yeah, it's all about balancing those two mandates out. And the market currently are priced in about 2 cuts till the end of the year. And again, that is data dependent.
Right.
Depends on where the job market is going to go, where the earnings are going to go. If we start to see a much more deterioration in the earning growth in the job market, we may have 2 in the third quarter.
Yeah.
Or if those 2 numbers are still relatively strong and resilient, we may not have any zero rate cut down the road.
Right. Totally agree. And if a rate cut didn't happen, I think of all the other things that are going on, that would probably be the market's least concern because we've been dealing with this interest rate level for a while. I think tariffs are probably still number one in everyone's book because it just ripples through everything. And at the end of the day, long term, tariffs get passed down eventually.
Yeah.
Companies are willing to. It happened during that happened during COVID. Initially in COVID, costs didn't jump because there was inventory. No one knew where COVID was going, but once COVID was here to stay and supplies strained up, we had all the supply issues, those prices went up, everything eventually got passed on. And we had that jump in inflation. So right now our inflation is trending at about 2.5% year over year, and that's pretty stable. You got to remind people the prices that have been increased are still built into the price.
Yeah.
Okay, it's just looking at the price last year compared to the price this year, right?
Yeah, that's one of the fallacies that we heard a lot from our clients saying that, Cynthia and Frank, you keep saying that inflation are getting under control, but we don't see it, we don't feel it. We still pay higher than last year and the year before because inflation is really measuring the speed of price increase.
Correct.
As long as that number is a positive number, we're never going to go back to the lower price tag before COVID.
No. And as a business owner, if the market can absorb the price, why would they be incentivized outside of competition or someone coming in and trying to cut prices?
Yeah.
If I know you're willing to pay this price, why would I cut the price?
Yeah.
So unfortunately, when you get huge increases in inflation, or what was the other tactic? They shrink packages, right? So you know, instead of getting 3 chicken breasts in my package for $10, I'm only getting 2.
Yep.
So you know, at the end of the day, they find a way to get paid, but they're rarely ever going to give it back.
Yeah, I think another point to add to the tariffs that people are concerned about, which is a really valid concern, that if we have a higher tariff, that's going to be the cost add to the price tag down the road and introduce inflation back to the market. But one thing to keep in mind, though, the tariff is a one-time add to the price tag, right? If down the road, worst case scenario, we have a double inflation for a year maybe, and then it will slowly get back to the 3%, maybe 2% down the road.
Right. Yeah, spot on. So why don't we talk a little bit about just, you know, investing? Because at the end of the day, I think people really appreciate our dissecting of all this news and trying to give them, you know, our thoughts on how to manage their expectation. I think that's really important, because when you don't know what to expect, people their behaviors, they tend to go negative. So, you know, part of our role as advisors is to make sure they understand what to expect, why it's working the way it's working. So we take some of the mystery and concern. We can't, you know, make this stuff go away. You know, we're as advisors and as you know, investors ourselves, and dealing with the same concerns everyone else is dealing with. We have to live with what we have. But what does it mean, you know, from a philosophical standpoint? How should be people adjusting their portfolio, if any? You know, we believe in, you know, diversified portfolios. We believe in really focusing on your investment strategy to match your financial plan, so that the long-term impact, your long-term decisions are always staying consistent. But it's always nervous and nerve-wracking is, should I be doing anything? You know, with what's going on, you mentioned earlier you know, being tactical could add value, or as our industry likes to call it, add alpha. But basically it's adding value to the portfolio. So what things should we be thinking about in regards to our, you know, our staying within our investment strategy, but yet looking at maybe certain positions within the portfolio? Should we maybe be making any adjustments?
Well, yeah, when it comes to investment, diversification is always the key. And sometimes it is more important than if we have a bull market. We always saying that high tide lift all boat. It's going to be hard to see that some clients are sometimes argue with us, we have those technology stock give us 30, 40, even 50% of the return. Why do I want to stay diversified? And until there is a correction, there's a pullback, there's recession coming to the market, and you start to see the benefit of having diversification in your portfolio. And it is still stay very true for at least for the next 6 months with all those uncertainty into the market. You never really know where the market is going to take us for the next 6 months. And that's when diversification is really going to help you stabilize your return. And when you have a much more smooth return, you and I see that all the time, investors seems to be more calm.
Consistency matters.
Yes, than all those up and down in the market, and they see their portfolio with a big slap into their balance, and they started to get more concerned about it. And in terms of allocation, I would say that allocation, active management still really matters because some valuation are very stretched, very expensive, and there are still relatively cheap stock, attractive cheap stock there in the market. If you're being active instead of investing into an index fund, that's kind of a plain vanilla strategy, but being active meaning that you go through the lens to really understand what is going on behind the scene in each of those business, and to see where the opportunity really lies on, and picking the right stock with the right valuation can really help you not only weather through the short-term volatility, but enhance the return in the long term.
Well, for those that are, always talk about two religions. You got those that do active management and those that do passive. I buy all indexes, but we've subscribed that you could still be tactical with indexes because, there's not one index generally for every stock position in the world. You have your S&P index, you could have a mid-cap index, you could have an international index. And right now, international year-to-date is outperforming the U.S.
Yeah.
So to your point about, diversification does matter. And, the better analogy I like to use is when you have an executive that works for a publicly traded company. If they work for a company that does very, very well, they could really retire with a lot of money because they get all these stock warrants and stock options that really juice their return, if the company's performing very, very well. The problem is that they have all this concentration risk in one company. And if that one company does poorly, and there's, many companies that were shining stars 20, 30 years ago that, the shine has come off the stock. And,
GE is one of example that it has been paying really attractive yield, attractive dividend for a long time, and everybody loves it until it all crashed.
Correct.
Yeah.
Yeah, and there's a number of companies like that. So if your wealth is tied to one company, just like you're saying, if you're tied to the Magnificent Seven, well, they might still have a continuous great run and all that, but 20 years from now, are they still going to be the same company? Does something change? There's always something that can impact any industry. So, the man-made index, if you look at the Dow Jones, which is really supposed to reflect the general health of the economy, if you look at the companies that make it up today, most of those companies weren't around 50 years ago or even earlier.
Yep.
I mean, so the darlings of 100 years ago or 75 years ago aren't around to be still darlings that they're part of the Dow Jones, which is supposed to reflect our economy. So the companies today that are on the Dow Jones might not be there 25 years from now. So if we're thinking long, diversification, really does matter. Yeah. So one of the key things we utilize with our clients and we're strong believers in is we call it a tripod versus having a two-legged stool versus a three-legged stool. And the whole implicit meaning is a three-legged stool is more stable than a two-legged stool. And most people think, in just tradable stocks, whether it's mutual funds or individual stocks or individual bonds or bond mutual funds. We utilize alternative investment assets because it's an asset that does not correlate with the other categories, meaning, if the stock market goes up, not necessarily alternative investments will do the same thing. Or when the market's down, doesn't mean alternatives will go down with it. It behaves in its own manner, which is good because it's not, as you pointed out earlier, not having all your eggs. I know you didn't use this term, but I know what you meant. Not all your eggs in one basket. So why don't we talk about how alternative investment assets could help, reduce risk and create more consistency in the portfolio? Because I think at the end of the day, most investors, that's what they're looking for is, I have a financial plan. I need to generate X percent from my portfolio so I can reach a certain financial goal. So how do I help create consistency so that when things go sideways or down in the market, I'm not ready to throw in the towel and say, okay, I can't do this anymore?
Yeah. Well, in terms of alternative investment, a couple of things for the benefit of the audience. I think it's worth to point out that there are a couple of fallacies that when you talk about alternative investment, instantly they will think, oh, these are too risky for me. I don't want to be part of it. I don't want to touch it, or I don't understand it. But in general, alternative investment is just anything that not a plain vanilla bond or stock positions can be considered as alternatives. We can have a long-short alternative investment strategy, which are still 100% invest into the public traded stock market. And we can have a private equity, which none of the stock are available for retail investors in the public traded stock market. So alternative strategy is a very broad term that can mean many different things for many different people. But I would say that don't consider alternative investment to be a risky asset class. It's just a different investment asset class.
Right.
And there are many different options within that basket, depends on what you're trying to achieve. there are investors out there using alternative investment, trying to de-risk their portfolio. So if you can put different flavors into your meal, it can make it much more flavorful.
And good analogy.
And there are investors there are really chasing returns. They may go to the venture capital that if they have a big kid, they're going to give them 30, 50, even 100% of the return. So depends on what you are trying to achieve. There is a solution in the alternative investment family that can help you with that.
Yes. And there are other categories, and you said it well, it is a broad category because you could invest in privately held companies or private equity. You could have private equity debt. So you're having debt issued by a private company. So, and actually the market, when you look at the number of private companies versus public, it's not even close. So I think the other benefit is that everyone responds to the economy. Right? If the economy is bad, usually impacts everybody. What I think we've seen as advisors with the alternative market space is that they tend to be less responsive to what I call the day-to-day market noise. Oh my God, there was a geopolitical issue in the Middle East. Oh, the president is saying I'm going to do this, and then the market just whiplashes you. And as an investor, it's like being in a car wreck. You're getting your head snapped back and forth. And it's like, and your head's spinning around. Where I think with alternative investment assets, they tend not to respond to what I call the daily market noise. So just from a calmness standpoint, I think that's an important part. However, again, all investments are subject to what's happening in the economy, good or bad, and again, it all ripples through every industry, whether it's a public industry or private industry. I think using alternative investment assets, as you pointed out, helps allow you to create more flavor in your portfolio by filling gaps, whether it's a risk gap or an opportunity gap, by selecting an alternative investment asset to complement the tradable investments, whether it's in the stock market or bond market.
Yeah, having alternative investment is all about setting the right expectation. There will be times that they outperform the public stock market when there is a market shock or market noise, as what we refer to, that those tend to be not highly correlated. And when you think about it, in the public market, everything is so liquid. There are investors like us understand the underlying reason of really driving the market noise or the market pullback. And there are retail investors is whatever broadcast on the news create the concern, and they can go sell, liquidate all their position the same day. But when it comes to alternative, because most of those alternative investments tend to have a gated liquidation, that it gives you time to really digest what's going on in the market. Is it really going to have a long-term impact to the economy, or those are just market noise or market shocks that it will be observed over time? And by the time for most of those alternative investments are being able to redeem and liquid, that noise is already kind of calmed down.
Yeah, it's dissipated.
Yeah.
Well, I think the key thing for the listeners is, in working with your advisor, or if you're doing it yourself, is, as we talk about, is your financial plan. I think people tend to look at their investment portfolio separately than their financial plan. And really, the sexy part of our business is the investments. Why? Because that's what's talked about every day. No one talks about protection planning and estate planning. They might find that boring, not interested, I don't care. But your financial plan is taking to you where you want to go. What your expectation in your life, what your purpose is, what you want to do 20, 30 years from now. So the strategy that you take in your investments, so this is not picking investments. We're just saying what strategy, because every strategy has a certain risk associated with it and a certain return expectation that you plug into your financial plan. But once you agree on your strategy, then it's up to you, or working with your advisor, to pick the right underlying investments to support that strategy, and to consistently curate and make sure that those investments are aligned with your expectation in the strategy. And then lastly, when you're looking at investments, making sure you're comparing apples to apples, right? You don't take a small cap stock and compare it to a large cap stock. You don't take an alternative investment asset and compare it to the S&P 500. They all have a role. I'm going to go back to your recipe analogy. When you're trying to create a great meal, they're all components that come together to create the great meal. The same thing with investment planning. There are components out there that you pick that need to work together, and so in doing so, that you'll have a lot more success. I think for the listeners, I was saying readers today, it's important that plan on seeing, as we conclude the telecast here, plan on seeing a lot more volatility, I think, between now and the end of the year. It would not surprise us to have at least one or two more pullbacks, maybe not as severe as what we had early on in the year, because I think the initial noise that the administration created caught everyone off guard. Now that, and I think they also expected, the administration to behave like the first administration, which it really isn't. It's definitely taking on a different tack, very focused on policy and putting, as he says, America first. So all those decisions are going to line up in that way. So I do feel that we're going to see increased pressure and more volatility. I think at the end of the year, when you look at the stock market in itself, I think will be positive. I think the bond market is probably going to be, from an earnings standpoint, you'll make money on earnings, but I don't think you're going to get any appreciation out of your bond portfolio given the interest rate pressure. And I think alternative investment assets can help take some of the risk, or as you said, de-risk the portfolio. But I would say, it's like going to Cedar Point here in Sandusky. It'll be a little bit of a roller coaster. We've hit a peak. In a perfect world, it'd be great to kind of stay there here, but it's unrealistic. There's going to be more geopolitical risk. There's going to be more tugging back with the Fed and what the Fed should do. If a country's not playing ball with President Trump and the administration, wouldn't be surprised to see, tariffs, come back and rear its head. And then lastly, I think all the things that happened in the first quarter, all those are going to, all those seeds that were planted with the existing tariffs, the fact now, you really can't buy more cheap inventory, all that stuff is going to kind of fall out. And so I would say, we're going to have a little bit of constriction in the economy. I don't know if you want to add to that, but a little more constriction in the next 6 months.
Yeah, I would say that in general, we talk about that be prepared for more volatility down the road. It's not going to be a smooth ride as we all enjoyed in 23 and 24. And in terms of the asset allocation, making sure that you really look into your investment strategy and peel the onion, understand what do you have, what do you own, and consider adding any kind of investment options that could help to smooth the volatility, de-risk your portfolio. And for those who are considered to have alternative investment adding to their portfolio, just be mindful that when it comes to alternative due diligence, it takes a whole lot more work to understand each of those strategies, which one would be right for you, and how those managers really work picking their underlying investment. It takes a whole lot of effort to understand how those works than picking an ETF or a mutual fund. So if you have an advisor that work with them to help you build a more diversified portfolio, incorporating the alternative investment strategies into your portfolio.
So Cynthia, why don't we, to help our listeners and viewers, why don't we talk a little more specifically? We mentioned the word, tactical investment allocation, and they're like, okay, that's an industry jargon term. What does that mean? And really, in simplest terms, it's, where should your money go within your strategy? So why don't you share, some thoughts given, short term. So we're not changing your strategy. We're just saying within the strategy, given the conditions that are going on, what type of adjustments can people think about making, and talking to their advisor about, or if they're doing it themselves, reflect on it themselves and say, hey, maybe I should consider this when I look at trying to weather the short-term bumpiness?
Really, when it comes to the investment allocation, we are talking about we set with a target allocation to begin with, and that target allocation, there is a boundary for us as the advisor are able to overweight, underweight, slightly to the left or to the right, depends on our perspective of the market and where we think which asset class is going to outperform. So that's really what tactical adjustment really means. When we look forward for the next 3 to 6 months, where do we think the most opportunity is going to lie at, where the most value is going to be created in the stock market? And for us, for the next 6 months, again, we are kind of neutral because of a lot of noise are still going to take time for us to see the clarity which direction is going to go. So we're not overall overweighting stock or underweighting stock. Is kind of a neutral position. By neutral, I mean if we're talking about a balanced strategy, the traditional balanced strategy is a 60-40 portfolio. By introducing alternative investment into a balanced strategy, our target allocation would be roughly 60% in the stock market, 25% in the bond, and 15% in the alternative investment. So overall, we're not overweighting that 60% exposure into the stock market, but within that 60% allocation in the stock market, we would probably tilt more towards large cap because we're still in the late phase of the economy. I don't think we're quite there yet to the early expansion of the economy. So we want to be mindful of not adding too much of the small cap to be specific, because those company stocks tend to be more volatile when there is market noise, there is market shocks. So we would consider to slightly overweight the large cap and slightly overweight the international. You pointed out that this year international outperformed domestic stocks by a big margin there. And that's kind of not a surprise. One is from the valuation standpoint, international stock has been undervalued for roughly over a decade now.
It's a little bit of a bargain.
Yeah, it's a bargain there. So for the U.S. Interest rate and the international interest rate, the spread is diminishing. So U.S. dollars are no longer as attractive, and we see the weakening in the U.S. dollars. Usually what happens is when U.S. dollars are weakening, we start to see that international stock outperform. And when U.S. dollar we have strong dollars, we see that international stock underperform. So for that reason, we started to see that the outperformance into the stock market and what we believe is going to be sustainable this time. So maybe add a little bit more to the international and the emerging market. But again, be selective about what stock you're going to invest in those markets.
Well, I would add too, again, companies that are much more susceptible to international trade, I would be cautious about putting more weighting there and look at what I call service industries. The biggest one would be financials, which I think are continuing to do well and would be much less susceptible to any type of tariff. I did want to cover something because you talked about guidelines and boundaries. So for our clients, we feel it's very important, again, to set expectation. We create a document called an IPS, which is an investment policy statement. And that investment policy statement for our clients outlines the strategy that we've agreed to with them. So with our clients, we have discretion, meaning, on our own accord, we can make whatever changes we need to make without having to seek any permission from the client. But what creates a safety net for the client and us is that we have to follow the guardrails that are put inside the investment policy statement saying, so for example, and I'm going to keep this at a high level, you referenced the traditional 60, well, our version of, because we use alternatives, 60, 25, 15 between stocks, bonds, and alternatives. Well, within the investment policy statement, overall, we have the ability to go up to 70% in stocks and as low as 50. So it gives us some ability as an advisor to be active, saying, well, if we're really bullish in the market, we can still maintain the balanced strategy even if we go up to 70% for a period of time. Same thing if we felt the market were bearish and we want to take some money off the table, we can go as low as 50 without seeking client permission. So not only do you have the global boundaries, but all the subcategories, large cap, mid cap, small cap, the same thing with bonds where you have short, intermediate, and long-term duration. We have parameters on how much we can add or deduct to stay within the overall policy. So this is what's important for our clients and for us, that if we're going to have consistency and a more realistic goal of achieving that outcome, that following the investment policy statement is very, very critical. So we advise clients, even if they're not clients of ours, that to make sure that with their financial advisor, or even if they're managing their own money, to create self-discipline, that they adhere to an investment policy statement, because that's really going to be the guiding light. If you're going to constantly, and again, I'm going to over-exaggerate, I'm not thinking that the market's going to do well, I'm going to go all to cash. Or I think the market's going to do great, I'm going to put everything in the stock market. That type of flip it back and forth actually can be very counterproductive and destructive to the long-term outcome of a portfolio.
Yeah, totally. Changing and switching strategies is a double-edged sword, especially if it's a market volatility driven. You have to be sure and to be correct on the way out and to be correct on the way in. And usually what we see for those kind of investors, either they're too late to be out and too late to be in. So they're missing too much of the early expansion or the rebound from the market by waiting for too long. And that's not really going to help with their long-term strategy.
Oh, for sure. And especially being out of the market. I mean, listen, the best way to make money in the market and to hedge against inflation and taxes is to be in the stock market in relationship to your risk profile and your goals. However, and there's plenty of studies by all the investment companies and mutual fund companies that if you miss over this period of time, the 20 best days or the 10 best days or even 5 best days, how destructive it is to your overall performance. So the double-edged sword that you talk about is very real, and it's very, very painful, because once you make those decisions, you can't get it back. It's done. It's embedded. You just have to move on. There's no way to really recover from that.
Yeah, there is a lot of studies showing that usually the best days and the worst days are clustered together. So when you are out of the market, are so concerned about what's going on in the market, there may be a 10% rebound the next day, the next week that you've missed. By missing those best 5 or 10 days, it's detrimental to your overall performance and the long-term growth of your strategy.
I mean, just think about just this first quarter. If you bailed or pulled out, you missed that uptick and you can't get that back. Even a bigger one that's still most recent is COVID. In March, within a 3-week period, the market dropped like 30%. And literally within a couple months, the market exceeded the previous high before going into COVID. And if you bailed because of I understand there was a lot of world panic, there was a lot of uncertainty, but because people lost faith and lost discipline, they pulled out, waited till, as you said, things felt safe to go back in. By that time, they sold at let's just say a 30% discount, and they can't recover that when they feel it's safe to go back in. So, well, let's end on some good news. I know you and I talked about some positive things to look at between now and the year. Why don't you share some thoughts?
Yeah, I would say the two good news that's really lies there, that which we have been talking about, are not. Yes, I know that we discussed a lot about volatility and uncertainty. I don't want our audience to be too concerned about it. So the two good news really there is, one is Fed. Fed, again, we talk about the data dependent, that Fed are really trying to balance between the inflation and the full job market. If there is anything, tell the Fed that okay, things are not going to the right direction, Fed can pull that trigger to cut rates sooner than we expected. And before COVID, when we have 0% interest rate, there isn't much Fed could do. Fed has two levers. Either is printing money, which introduced the inflation during COVID.
Right.
Yep.
Throwing gasoline on a bonfire.
Exactly. And then the second lever is the interest rate. Now they have those two levers in hand, and the interest rate could be a very powerful tool that if we are heading into a recession, they can cut rate to boost the consumer consumption. That's going to help. And number two is we still have $7 trillion of cash sitting there on the sideline.
Not being used.
Now, those cash are being paid with a 4% yield, which is not too bad. And that's why there's really no incentive for them to go back to other investment opportunities to get a better return by adding to those standpoint, adding too much risk to their portfolio. If Fed cut rate and the yield they're getting from their money market fund are not beyond 4%, it comes down to 2.5 to 3%, and they need to hit a target return, maybe a 6 or 7%. They have to go somewhere else to fund the yield. So that potentially going to put a floor for the bond market, because usually that's the first asset class they go to, one step away from the money market. And then the second alternative options would be the stock market. So with that, we still have some powder in the economy that going to really be there, hold the floor.
That's great. Well, and one thing for the listeners to know, we're the only country where the Federal Reserve and same type of entity within other countries has that dual mandate. So I think it's very important because it creates another safety net. And I think one thing to take back, when you look at all the terrible things that have happened economically, the Great Depression in 1929 and all the things, the dot-com and COVID, and there's others, we as a country, we've learned and we've tried to create additional safeguards within reason, because you don't want to get in the way of the free economy and capitalism, which are really two different things. But what our country is known for is the fact that we have more, or actually what I call least government interference in the business world compared to other countries. So the dual mandate is really important. It's unique. I don't think a lot of people know that, so I wanted to add that. So, well, anything else you want to share? We're good to wrap up?
I think we covered everything that we want to cover.
That's great. Well, hey, for everyone who's listening or viewing the podcast, we want to, Cynthia and I, on behalf of Return on Life Wealth Partners, want to thank you for being attentive and taking this information and using it wisely in their personal situation. If there's any questions that you have, feel free to reach out. Our number is 440-740-0130, or you can go to our website, returnonlifewealth.com, and contact us via the website. If you like what you hear and you want more of it and you want your friends to know, or family, please share our episode. Ask them to follow us on Frank Wealth Insights. We're very appreciative that you invested time with us and hopefully walked away with some great information. Continue to have a wonderful summer and be safe, and we'll look forward to our next episode next month. Thank you.